Hi, I'm Frank Masiosi, and I'm here today with David Dietz. David has given me his card, so I get this just right. He's a managing principal and senior investment strategist of PPAC Private Wealth Management, his office is located right here in Summit. David, how are you?
A pleasure to be with you, Frank.
Likewise. This is the first episode of what we are calling a Summit Wealth Manager's Perspective. And we're going to cover a wide variety of subjects which have really global significance, but local impact. And David is located right here in Summit. So let's just get started with kind of a broad question. What's your forecast for the economy for the balance of the year?
Absolutely. Well, I think what we're seeing here is a slowing in the economy. And indeed, policymakers, at least the Federal Reserve, wants to slow the economy. Why? Because we've had a spike in inflation with the post-pandemic supply chain hijinks and, of course, the COVID extra payouts caused a big spur in demand. Prices moved up. And now the Federal Reserve wants to take that excess liquidity out of the system, and there's no way that you can cut inflation without at the same time slowing the economy. And slowing the economy. And so we are starting to see that it's taking longer than many had projected. Indeed, at about this time last year, everyone thought we'd have a recession. By the start of this year, we haven't seen it yet. Recession, of course, is 2 quarters in a row of down GDP, but we are starting to see signs, particularly in real estate and other interest rate sensitive areas, that economy is starting to cool.
Okay. Well, of course, what people are really interested in is the markets.
Yeah.
So how is the economy going to affect the markets, or how are the markets going to react?
Yeah, exactly. So, I mean, there's so many factors that go into divining where the market's going. They say if you project the economy, don't give a date. If you project the market, don't give a level. But we're constructive here. What are the tailwinds that could drive higher stock prices? I do think that lower inflation will allow interest rates to come down. There's so many people here who are sitting with big fat 5% yields on their money markets, but if those yields start to come down, they're going to say, honey, we got to do something a little bit more aggressive to make our numbers. Second, of course, is the economy has stayed strong. Resilient is the word that people are using. The unemployment has a 3 handle. Remember, the consumer is 70% of the economy. So as long as they have jobs, the American consumer is going to go out and spend. So that's a big positive. We also have an election year here. No one wants to see that economy go down the tube just as people are going to the polls. So what we are seeing, of course, is huge spending by Washington for all sorts of projects. But the bottom line is we are spending a lot more than we're taking in taxes. And that's also a big tailwind behind the market.
I guess if I had to label that, I'd call it cautiously optimistic.
Cautiously optimistic. I mean, we tend to be long-term investors. We find it very difficult to try and time an entrance and an exit to the market. So we like kind of the steady as she goes. Having said that, there are plenty of risks out there. One is we have, of course, the Federal Reserve has raised interest rates dramatically. They were close to 1/4% about 24 months ago. Right now, the federal funds rate's between 5.25% and 5.5%. That's a huge jolt to the economy. We haven't seen a big fallout yet. Remember, a lot of people refinanced their home mortgages or are still enjoying a 3.5% 30-year mortgage. Companies did the same. They borrowed when the rates were low. But at a certain point, maturities come up, people have to move, and that's where it could get very, very difficult for the economy as people face the problem of having to pay more on their debt.
Okay. So a lot of people are looking for alternatives. Artificial intelligence is one that comes to mind. Would you put your clients in that sort of an investment?
Well, so it's a big box that you just opened there. There's alternatives which, tend to, for example, the promise is almost as good as equity returns with bond-like risk. And the strategies that can be used is as vague as myriad as vague as the name alternatives, where you could be shorting stocks you don't like, going long stocks you do like, adding commodities into the mix, options, derivatives, and so forth. Again, the problem is for many investors, it's a black box. And so you don't really know what they're doing. Often there are long lockup periods. It also may not be tax efficient. Remember, private investors is not what you make, it's what you make after taxes. And so the holy grail, of course, is to hold a stock for the long haul and get that long-term capital gains rate and that reduced rate on dividends. But alternatives are doing all sorts of strategies which may not and usually do not qualify for that favorable long-term capital gain qualified dividend treatment. So that's alternatives in a nutshell. You really have to look at each situation. For the most part, we prefer plain Jane, plain vanilla stocks and bonds. But, in the right situation, maybe the alternatives make sense, particularly in a non-taxable event or for an institution account or for an institution which is non-taxable. In terms of AI, I'm not a technology wizard, but from everything I've read, AI has the potential to change how we do everything, to make economies globally more efficient. Instead of people having to draft papers and emails and so forth, the AI can spit it out. Instead of having to research yourself myriads and reams of web pages, the AI can do it perhaps within minutes or seconds. Having said that, we have seen in the past that often it takes not just years, perhaps even decades for the efficiencies to kick in. And the problem is when I see, for example, the quintessential AI stock, NVIDIA, up 230%, now trading at 100 times free cash flow with a multiple of 36. Now, Frank, that's not 36 times earnings, that's 36 times sales. A lot of the potential financial advantage may have already been pulled forward. And of course, who knows where government regulation may end up, competition, etc.
Wow. Do those feelings that you've just expressed spill over to crypto exchange traded funds as well?
Well, that's a very interesting situation. You've got two aspects going on there. You've got crypto, and of course the largest cryptocurrency is Bitcoin. And of course opinions range all over the lot. The most optimistic say it's a new store of value. It takes advantage of technology efficiencies to transfer value instantly worldwide. It avoids the eyes of the tax collector. It's not so prone to inflation. It's a hedge on economies and paper currencies. That's the bullish take on it. The negative take, of course, is exactly how is Bitcoin kept scarce? What will guarantee it always stays scarce? Then there's the whole thing of government regulation. Governments love paper currencies when they issue it because they have control over the payment of their debts and controlling the economy. But when it's a third party's technology, which is providing the means of transaction, the store of value, they've lost control over it. Case in point, China. China has banned the use of Bitcoin in their 1 trillion plus population. And so, Bitcoin is, it doesn't produce anything. It doesn't pay out any income. So luminaries like Warren Buffett and the late Charlie Munger have, had all sorts of unmentionable terms to characterize it. And we have seen things like this perhaps collapse. And even if you agree in, let's say, crypto, it's like, will Bitcoin be the survivor? There's hundreds of different crypto currencies. So a lot of people hedge and say, well, we like blockchain, the system behind it, but we're not sure about cryptocurrencies.
It's sort of like liking the concept, but not the practical application. So let's switch to a slightly different subject and a real imponderable. What effect are the elections going to have on financial markets?
Yeah, great question. Well, we know from history that the fourth year of incumbent or of a first-year presidency tends to be a good year. And when you think about it, as many famous pundits have said, it's the economy, stupid. And so as you're preparing to run for re-election, you want to make sure that the economy is sound. You don't want to give voters going to the polls in November a reason to say, hey, my job, the market's in the tank, my job is shaky, I'm not going to get a bonus, throw the bums out. And so historically, you see a lot of stimulus coming out of Washington. We're seeing it this year, which is a positive. So that's one way to look at it. The other way to look at it is what happens post-November. And people try and divine, depending on who wins, what industries, stock sectors, portions of the economy will win or be a loser. So, historically, the Republicans have been associated with, for example, fossil fuels, with a kinder touch to Wall Street, for example, while Democrats have been, talking about more infrastructure spending, higher taxes and so forth, more regulation, perhaps in an effort to make a greener economy. So based on those things, people try and hedge what they want to invest in depending on what they think is going to be the outcome in November.
So I'm trying to digest all of that and scratch my own crystal ball. Much food for thought. What do you expect the Fed to do?
Well, the Fed, we just got some minutes of their last meeting, and basically they're pleased with the fact that they have started to bend the curve on inflation. And so you get the sense there that they don't feel that any more rate hikes are necessary. That's probably off the table. They have given a big jolt to the economy, and inflation is coming down as projected. The question is, can they get it all the way down to that 2% historical target? And some people say it's that last mile that can be very difficult. And so we think, indeed, their last predictions following their December meeting was that there'd be 3 rate cuts. That's what the Fed projected in the course of 2024. At the start of this year, Wall Street was talking about 5 to 6 rate hikes. So there was a disparity. It seems like with some hotter than expected inflation numbers coming out in January, that Wall Street is starting to go towards the Fed's less rate hikes, rate cuts. I do think that the Fed will cut, because here's the problem. As inflation comes down, if they don't cut, that means the difference between inflation and interest rates gets bigger and bigger. That's the so-called real interest rate. As that gets larger, that puts a big drag on the economy. And if held for too long, borrowers can be unable to pay their bills. Consumers are unable to buy homes and cars, and that can lead to a tough economy with a lot of people losing jobs. They'd rather get ahead of that if at all possible.
How do you feel about the size of the federal deficit and debt? Does that bother you?
I do think that spending beyond your means as a general proposition is not a good thing. It can be justified in limited situations where there's an emergency. World War II, COVID-19, where we need to muster all the resources without regard to the cost to fix the problem, deal with the issue, save lives. The problem here, of course, is COVID-19 is now in the rearview mirror. We're not directly involved in a war, and we're still spending a lot more than we're taking in. Indeed, now the deficits are over $1 trillion. And of course, we've got to pay for that. We've had a get out of jail free card for the last 10 or 15 years because interest rates have been low, but they're starting to creep up here. So the question is, of course, the government will always be able to pay their bills, but as interest rates go higher because people are can't, don't have enough money to buy all this debt, then private sector borrowers could get crowded out. They have to pay even more because they're less creditworthy, and all of a sudden some projects will be shelved. The economy will cool. Jobless rates could go up. And then what happens? Does the Federal Reserve try and fix things by printing more money, forcing rates down? Then you can get an inflationary spiral. The question is, at what level of debt and deficits do all these problems start? No one knows for sure.
Okay. David, what are your thoughts about China? It seems as if every time I open the newspaper, I see negative news about China. And it was not that way a couple of years ago. You couldn't open the paper without seeing positive news.
The great enigmas that investment strategists and others are worried about now with China. Remember, at the start of this century, it's going to be the century of the East.
Yeah.
And with their work ethic, and starting from a low level of economic development and accelerating, they were going to be the big economic engine for the 21st century. However, what has happened here is that as they created a lot of debt, they really expanded their property sector to the point where it became a bubble over there as well. At the same time, many of the tech companies there got pretty big for their britches as far as the Chinese government was concerned. And so, like we've done here, kind of tried to tether them in, not allow them to have so much control, put more regulations on them. So basically, it's the property sector imploding together with the tech sector becoming very heavily regulated, which has caused the economy to start to go downhill. And indeed, the Chinese market is now at a 5-year low here. Valuations are very attractive, but the question is, what will the Chinese government do to try and jumpstart it? On the one hand, I think they realize that to feed their people and to become the economic power they aspire to be, they've got to relax conditions, allow foreign capital to comfortably come in. Yet at the same time, they're worried, it's not a democracy over there. They're worried about maintaining control. So it's a real balancing act there between maintaining control and trying to get their economy off the ground. So from an investor's point of view, here's the conundrum. The valuations have never been better, but the risks have never been higher. But when you think about it, it's hard to find low prices without a scary story to link to it.
Yeah. Plus, they've got the demographic problem.
Yeah.
Speaking of China, the relationship between China and Taiwan has got to have some impact on the markets. And expanding that thought more broadly, there's plenty going on in other parts of the world, Ukraine, for example. Wars do have an effect on the market, don't they?
Absolutely. But the real head scratcher is that we have seen this year the market hit new highs. But as you pointed out, we've got 2 wars raging, one in the Ukraine, one, of course, in the Middle East, and tensions rapidly escalating between China and Taiwan. And so how can that be? I think there's a couple responses there. One is that particularly in terms of Russia and in the war in the Middle East, it hasn't been the biggest economic powers that have been involved. It's not Germany, it's not the UK, it's not Japan and so forth. It has put pressure on oil prices, but we tried to embargo the Russian oil. It seems like it's just going out to other areas. Indeed, oil prices and energy prices have come back down. The worst fears of Europe freezing because gas prices were so high have not been realized. I just think it's very hard to keep Russia from exporting. A lot, I think, is going to India, who therefore doesn't have to buy as much from other sources. Prices have gone high. In the Middle East, that Gaza-Israel area is not the big energy producing area. The worst case scenario is just if Iran really gets involved and somehow someone cuts off the Straits of Hormuz. There's no way around a Cape of Good Hope or similar to get through the Strait of Hormuz. If that gets shut down, that could be a problem. Remember, in the 1970s, when we had the geopolitical concerns, particularly with the Middle East, we were a net energy importer. Today, we are energy self-sufficient. That helps us a great deal. In terms of China and Taiwan, who knows? In some ways, they've been at each other's throats for decades now, ever since Taiwan broke off in 1949. Does China take advantage of the situation to do something? We're all on tenterhooks trying to check that out. The other flip side, of course, is the wartime economy tends to be a strong economy type of situation. Our defense companies are working hand over fist to develop more munitions to fill our coffers that we have shared with the Ukraine and with Israel, and to prepare for worse to come. And so in some ways, it just doesn't seem to be affecting our economic situation. I always use the Friday night dinner test. What does that mean? Whatever you read in the headlines, is it enough for you to tell your spouse, we're not going out for dinner on Friday night? If we say it's terrible, should we have Italian or Chinese? It's not going to tip over the American economy.
I'll have to remember that. So the U.S. markets in the recent past seem to be doing, if I'm not mistaken, a whole lot better than pretty much the whole rest of the world. Can we count on that continuing? Seems almost too good to be true.
It is almost too good to be true, and it's something strategists worry about. So, for example, there is the MSCI Global Index, which is a market cap weighted assortment of all the companies on the planet. And now the US companies make up 70% of that. We've never seen one country so dominate that index the way it is now. There's a couple things going on. One is the expansion of technology. Because of AI and the optimism for all things technology, most of the technology is done in this country. So when you look at what's going on in our market, is the growth of the technology companies, and the other countries, not to say that they don't have any technology, they don't have your Microsofts or Alphabets or Meta platforms the way we do, and so that's one reason driving the growth. So one answer to your question is, where's U.S. technology going? If it's blue skies ahead, then it's probably going to stay the same. The other thing, of course, is our economy. We were able to get out of COVID-19 more quickly than some of the overseas economies, particularly, of course, the second largest economy, China. They kept that locked down. They locked down their economy for far longer and far more severely than we did, and that had a huge negative effect on their economy. So by taking advantage of the vaccines and we were able to get back on our feet more quickly. That's helped, but that's, of course, in the rearview mirror. I would have to say that over the long haul, expect things to be cyclical. We know we have our problems here. Just look at what we're facing in the elections. Look at our debt that we were just talking about. So that I think that the smart investor probably wants to diversify, rebalance, and not give up on overseas opportunities.
Okay. We've heard some great thoughts about basically the world. Let's come back to Summit, New Jersey for a minute. You're based in Summit, and what are your thoughts about the local economy?
Well, I think the local economy start with real estate. If home prices hold firm, I think that people will be very happy with coming here. And so the question is, what's going to drive home prices here? One is we have a great school system. I served on the Board of Ed. I was honored to do so. I know our public schools are first rate, and when people are looking for a place to buy a home, it's going to be, how are the kids going to be educated? That's always job one. And even if they're skeptical of our school system, we have 3 terrific private schools right within our borders and a number of great ones outside our borders. So there's all sorts of educational opportunities, unmatched really in most of the world. So I think that alone bodes well for Summit. The other thing, of course, is New York City economy. A lot of the people who live here either work in New York City or have ties to New York City. So if New York City has issues, that can only have a spillover effect to Summit. But by all accounts, although a lot of the commercial real estate is less than fully occupied, And of course, they're having problems with the traditional problems that New York and other large cities has. For the most part, I know my son just recently moved back to New York City. It's still a magnet for energetic young people and for international capital and so forth. So I think that bodes well. And then finally, of course, what we're all faced with as homeowners is mortgage rates. You can't sell your home. It's not going to maintain its home if someone who might buy it can't afford it. We saw interest rates as low as 3% a few years ago. They got briefly up to 8%. Now they've come back, but still it's almost twice as expensive in terms of your cash flow to buy a home today than it was. Right now, that has not caused any depression in home prices because most people don't want to sell. They're afraid that they'll give up their 3% mortgage and then what will they do for the next house and they have to pay a larger. So the supply is low. And of course, people for the most part have jobs, and so that's allowing real estate prices to stay high despite the higher interest rates. But will that always stay the case? Stay tuned.
Okay. You mentioned real estate. Everybody who owns a home has a real estate investment. In general, what place does real estate have in an investment portfolio, including or excluding the home?
Yeah. So, we're cautious about real estate as an investment for the average person. First of all, it breaks all the diversification rules. Let's say someone has, a $1 million portfolio, and now they're talking about adding a $600,000 property to it. Well, that's 60%. Or if you, or maybe a little bit less if you add the home and the financial portfolio together. But if I were to buy a stock and put more than 10% of someone's portfolio in any one stock, I'd be fired. So why should it make any sense to put 60% in a single piece of property? So diversification is tough with real estate. Second, of course, is liquidity. All things being equal, you want to be agile. You see an opportunity, you want to move in that direction. Now, with someone's stock portfolio, I can reduce that to cash in about 48 business hours. But if you asked a realtor how long would it take to sell your home, they say, well, first we're going to have to do the buff up and so forth. That could take some months and so forth. It depends what you ask, but bottom line, between the time you decide to sell and actually have the money in hands, that's months. At a minimum. And so that's not particularly helpful either. And of course, real estate has all sorts of ancillary problems. With the stock portfolio, you just kind of sit back and watch your dividends come in. But depending on how you're involved with real estate, you might be getting calls at 2 a.m. in the morning because the toilet's plugged up, or there's some sort of, or someone doesn't pay their rent, and now it becomes a full-time job instead of a retirement investment strategy.
So we have about 1 minute left. In the 1 minute that we have left, what piece of advice would you give? If you could only have one piece of advice, what would it be for the average investor?
Yeah, absolutely. So first of all, always have an asset allocation plan. A certain amount in stocks, a certain amount in bonds, a certain amount in cash. Take a look at where you are now, and whatever that plan was, rebalance back there. For many people, I think they're going to find themselves stock heavy right now because the markets have done well over the last 12 to 16 months, and bonds haven't done as well because of the rise in interest rates. So you may want to be rebalancing to your fixed income portion of your portfolio. And of course, cash is no longer trash. It is yielding 5%. So make sure whatever your plan is for cash is adhered to. And perhaps in the stock portfolio, have a balance between domestic true blue American stocks and international, and consider adding a little bit more overseas to take advantage of the higher dividends, the lower valuation, the fact that it's a little out of favor.
David, great thoughts. Thank you very much for being here with me. And if there's some subject that we haven't covered that you're interested in, David's local. Pick up the phone and give him a call. He'll be glad to talk to you. Thank you.
Thank you, Frank.